Hey guys, welcome back. Today we are going to solve a problem which is from transfer pricing, a comprehensive problem covering all the no related provisions, some related provisions. You will be getting know about some of the relevant provisions which are helpful for the exam only. So, okay, transfer pricing. In this problem, what method we are going to solve is, let's see. Okay, let's quickly read the question. Fast growth limited is there. Fast growth limited is there. It's an Indian company belonging to Bola Group. Both are AEs, no, associated enterprise, engaged in sale of air conditioners, engaged in sale of air conditioners throughout India. Eric Incorporation of USA, having 28% shareholdings in this company, is also having 28% shareholding in more than 26% itself. They'll become deemed associated enterprises. No, so Eric and Fast Growth also becomes AEs, and it belongs to Bolo Group also. This company is also Bolo Group is the group, top group, and below that Eric and Fast Growth is coming. Okay, during the financial year 25-26, Fast Growth purchased 20,000 air conditioners manufactured by Eric. Okay, at a price of 70,000, 70,000 per unit. Okay. uh, 70,000. Okay, it's not, we'll use this itself. Okay, 70,000 per unit. Identical units manufactured. This is an unrelated party transaction. Unrelated, no, uncomparable, unrelated. Okay, sorry, comparable, unrelated transaction. It has been given in the question, which is 65,000 per unit. So this method is cup method. So we are going to use cup method here. Okay, and Eric gave credit period of 1 month to Fast Growth, and where unrelated parties gave credit period of 2 months. Okay, this is a functional adjustment. We have to adjust the functional adjustment here, and the cost of capital they are charging is 12% per annum. Okay, right. The supply be assumed as uniform throughout the year. Okay, 20,000 is the standard unit purchasing from both the suppliers. Okay, this is our ATP. This is our ALP. Okay, what they have asked us to find out is ALP per unit and income addition, total income of change in total income of Fast Growth. Primary adjustment is proposed to be made. Okay, primary adjustment proposed on a suo motu basis. Now, what will be the time limit for repatriation of excess money? Okay, and the consequence if not repatriated of excess money. So all these are kind of provisions only. We have to write a descriptive kind of. Provisions only. The solving part ends here. Okay, after this we have to only recall the provisions, and we have to present in the paper. Tax liability if such repatriation of excess funds uh, is not opted by Fast Growth Limited. Okay, if not repatriated means the Fast Growth Limited has to pay some tax, some tax percentage on the transfer pricing value. No, so that has to be paid by the Fast Growth. Consequence of repatriation of money by Zeet Limited. Okay, this is also another company belonging to Volo Group only. So if that company repatriate, na, it's okay. Well, like that, it's they are asking in the question. So let's quickly solve the problem. Okay, first truth is that, okay, like Bolo Group is having Fast Growth is the Indian company. Eric comes into play, and Zeet at last it comes into play. Okay, unrelated party is here. Okay, so Eric is no selling 20,000 air conditioners at rupees 70,000. Unrelated party is transferring 20,000 units at rupees 65,000 units. So this is ATP, average actual transaction price. This ALP, arm's length price. Okay, Now, what's the functional adjustments given in the question? Eric is giving 1 month credit period. You unrelated party is giving 2 month credit period. That the interest rate on that credit period is 12%. So what we have to do is we have to find out the actual arm's length price. Okay, what's the comparable price, which is rupees 65,000. 65,000 are priced to third parties. Price from third parties. Okay, what's the functional adjustment? Here he is paying 65,000 to who is that? Unrelated party, but he is paying 70,000 to related party, which is Eric. So he is paying excess to reduce his total income. To reduce his total income, right? So what we have to do is we have to no consider the ALP only for this transaction. For this, we have to find out the ALP. For that, we need the functional adjustment. Functional adjustment here is the credit period. 1 month credit period is excessively that unrelated party is giving. So we have to reduce the cost of that 1 month excess additional credit period. Okay, excess credit period, which is 1 month excess credit period. How much? 65,000 into 12% into 1 by 12, which is 65,000 into 12% into divided by 12, which is 650. Subtract. So the actual cost will be, actual arm's length price will be 65,000 minus 650, which is 64,350 is the arm's length price. Okay, this is the price Eric should have been sold to Fast Growth, but it sold at a higher price to reduce the total income of Fast Growth. So what we have to do is we have to consider this as the purchase price for 20,000 units. So into 20,000 units. Okay, so okay, this is the ALP, right? So what's the ATP? ATP total income to be increased, which is ATP minus ALP. ATP is 70,000, ALP is 64,350, which comes around 70,000 minus 64,350, which is 5,650. Okay, 5,650 is the income price ALP per unit. This is the adjustment value we have to make for all the 20,000 units. Okay, 5,650 into 20,000, which is 11.3 crore. 11.3 crore is the increased income, total income increased by way of primary adjustment. Okay, we have done finishing the primary adjustment. We found the value, which is 11.3 crore added to the balance sheet. The company has to pay tax for 11.3 crore. Right. Now, if primary adjustment is proposed to be made by Fast Growth on suo motu basis, okay, so they have proposed. So if primary adjustment is proposed to be made by Fast Growth Limited, okay, on a suo motu basis, after while they have calculating the the ALP, they on a suo motu basis, if they are filing the ALP, ALP of 64,350, how much time will be given to them for the secondary adjustment, which is the repatriation of that excess funds from the Eric Limited. Okay, for the what I'm saying is primary adjustment we have done. Okay, we have added 11.3 crore into our books as profit, Okay, we have paid a 30% or something tax pay, we have paid tax, but the 11.3 crore is not in our hands. This is still with the Eric Limited only. It has to repatriate to the fast growth. That 11.3 crore has to be repatriated to the 11.3 crore, because we have shown this as a income in books, no? So this cash should be reversed back from the Eric. So for that, the time limit is given as, so since the primary adjustment is proposed to be, is primary adjustment is proposed by fast growth limited, it's on suo moto basis. He has the time from due date from 30th November to 90 days. It has time to repatriate till 28th Feb. It is the last day to repatriate the money. If it's not repatriated, that's the next question. If the amount is not repatriated, the 11.3 crore not repatriated till this date, then the company has to face the consequence of paying interest, paying tax on interest income. So it's deemed to be like, I'll use this one. If 30 November and 28 Feb, if amount 90 days, amount not repatriated, 11.3 crore not repatriated, then this 11.3 crore is given as a loan to Eric, and Eric will pay back the interest every year at SBI rate. Okay, so that interest will be treated as a interest income in the books of Fast Growth Limited, and this will be treated as a loan to Eric. So what will happen is, how interest is calculated is, interest at, if it is in foreign, if it is Indian income, marginal cost of funds lending rate of SBI on first of relevant previous year, plus that rate plus 3.25% is the rate. The interest should be the interest income should be calculated if it is Indian currency. If it is in foreign currency, then 6 months from the previous year, 6 months end of previous year, which is 30th November, so 30th September of relevant previous year, whatever the LIBOR rate is the foreign exchange rate. Okay, so plus 3% would be the interest income that has to be recorded in the fast growth books as income, interest income. This has to be recorded, and every year the interest income, and every year that tax on interest income will be paid to the government, to Indian government. So this is the thing we have to know. If it is not repatriated, this is the case for them. Okay, tax liability if such repatriation of excess funds is not opted by. Okay, the fast growth says that I don't want to I don't want to repatriate the excess funds. What's the tax I have to pay to stop the stop the consequence of excess money? What the government is saying is, okay, you don't need to repatriate, but you need to pay the tax of 11.3 crore into 20.9664 percentage. This is the percentage determined by government. 11.3 crore into 20.9664 percentage, which is 2.37 crore will be paid as tax to stop this process. Okay, 2.37 crore will be paid to Indian government, okay, to stop this consequence of not repatriation. Consequence of repatriation of money, if paid by Zeet Limited, Zeet Inc. of Canada. This is also another company belonging to Bolo Group only, so they are associated company. So there is no consequence for this for here, because any associated company, not Bolo, not Eric, they don't need to pay. Even Zeet, even any other company which is which is belonging to Bolo Group, they can pay the 11.3 crore to Fast Growth Limited to stop the repatriation, stop the consequence of not repatriation. So no issues, the company can repatriate. So this is the problem, full of provisions with very simple provisions only. Slowly we learn the provisions. These problems are really easy to crack. Thank you.